We're here to share the Silicon Valley real estate market update for the week ending March the 6th, presented March the 7th. It's actually data as of March the 8th, and that's because I do a 10-year median looking back, comparing the same weeks. I use March 1st as my start date, and not much happens on Saturday as far as reporting closings because the recorder's office is closed or offers accepted. There's a lot of open house activity, so a lot of new offers are generated from this week, but they're not presented till later. These are the key chapters here that we're going to be going over, the graphics associated with them. You can jump to the chapter you find most interesting using the timestamps in the YouTube description below. Let's get into the first data slide. Here what we're doing is we're looking at three components. The purple line, the bold line, is the turnover time. It's a theoretical number of how long it takes the market to sell its existing inventory one time at the existing rate of sales. No new inventory came on the marketplace. You can see that we're about 122%, so a little bit slower than normal. It's been climbing the last couple of weeks fairly steeply. It did the same thing last year, and we'll see what time tells, but that means it's taking a little bit longer. The market's a little bit slower than it normally is, by 20%, which is starting to be a significant amount of slowdown. It's 1/5 longer than it normally takes. The next slide is the offers accepted. I don't look at pending transactions. I actually look at offers accepted for the past 5 weeks, and you can see that's down around 92%. Now, that may sound like a bad number, but actually based on everything since the 2022 price correction, is actually a good number. You can see it's basically the highest the orange has been in quite a long time. We were pretty much around 20% for the last 2 years and 30% for 2023. Be only missing about 8% of the market is actually fairly good. And the third and final one on this series is the active inventory. I just heard this past week from several people analyzing the marketplace, the same market that I analyze, saying that we have limited inventory. Well, we actually have 14% more available listings right now, active available listings, than we do typically for this time of the year. If you want to say that Silicon Valley is in a chronic shortage of inventory, I'm not going to disagree with that. But to say that we have limited supply of inventory when it's 14% more than we typically have, I think it's a stretch. You can see it's climbed up rapidly since the first of the year. And that's one of the huge advantages of my particular data set is you're looking at information as of Friday night at midnight. So you're talking about data that's less than 10 hours old at the time of the recording. It'll be older by the time you watch the video thing, but nobody else is that current. In fact, one of the reports I listened to was for the month of December. And I'm going, okay, last time I looked at the calendar, we were already into March. Now we're looking at a group of different metrics. We're looking at this week is in the current center of the graph. The purple line is the raw data. And that's why the purple line stops at the center. Going forward are the trend data. The gray line is always the typical, which is defined as the median for the past 10 years, using my March 1st start calendar year, marching through a week at a time all the way through February 21st. Then I jump 8 days, normally 9 days on a year back to March 1st. And that's why we jumped. Right now, what I'm doing is I'm using an extra day from the past. So I'm going back essentially 36 days, but my current day data, which started at midnight last night, isn't in the data set. So I'm still okay. And I can do that for Sunday, Saturday, Sunday, and even Monday. But once you start getting Tuesday, Wednesday, then it has to adjust. And I'll look back at how I adjusted it in the past. The blue line is the line that favors buyers, ice cold buyers marketplace. Red is the red hot sellers marketplace. They're the same except for their reverse. In other words, they're either the 10 or the 90 percentile. On this, you're talking about turnover time. So a short turnover time favors the seller. So that would be the 10 percentile. And the 90 percentile, a long turnover time, favors the buyer. And that's why it would be blue in color. And you can see the purple line is coming up to the blue line. You're close to the 90th percentile of where we are. And what are we talking about? We're 22% slower than we normally are. We're currently taking essentially 37 days to sell your marketplace one time, and normal at this time of the year is 30. It's 1 week longer than normal, and the longest you'd expect it to be, the slowest turnover time, is 39 days. So you're 2 days faster still than the slowest. Now, a quick turnover time is 16 days. So anyone would say there's a huge difference between 16 days, 2 weeks, and 37 days, which is a little over 5 weeks. Marketing time is a concept that's a lot easier for a lot of people to understand. And that's simply looking at the current successful sellers, when they accepted the offer, how long were they on the market? And then we look at 3 out of 4 sellers. The reason I picked that is about half the sellers come on the marketplace and sell their home right away. So they don't count. And then I look at essentially the median of the typical seller that doesn't sell immediately, but is serious about selling. The negative of this is it doesn't count the unsuccessful seller that came on the market, made an honest attempt, but did not sell for whatever reason. And typically you can correct almost everything with price. So the turnover rate includes the unsuccessful seller. The marketing time only includes the successful sellers. There is something of interesting note here, is because I'm using a 10-year median, you would expect the graph to follow the gray line, which is the normal marketplace. But notice how much earlier, the shape of the line is the same as the gray line, but it shifted. It's 1 week earlier for the peak. The plateau is only 2 weeks long. Instead of here, it's about 6 weeks long. And then it started sliding down 3 weeks ago in a normal marketplace. But this year we started sliding down at 7 weeks ago. So we're 4 weeks ahead of schedule, but now we're just falling right along the bottom here. And eventually what's going to happen is the gray line's going to catch up to us, and it's going to be there in 1 or 2 more weeks at most if everything goes normal. And so marketing time will go from 77% faster than normal, probably to normal here in just a couple weeks. What are we talking about? We're talking about right now we're selling homes in 15 days. The fastest we normally sell them in is 14, typical is 20. So you're almost a full week faster than typical. The sellers that are realistically priced are able to sell quickly in this kind of marketplace. As price reductions, this is sort of a measure of sellers' expectations with the market reality. And you can see we were right on top of typical. Now we're just starting to come down a little bit on a little bit more price reductions than typical. What are we talking about? Only half of 1%. The reason this number is so small is the vast majority of the sellers do no price adjustments. But even though half of 1% is a small number, it's 28% larger price reductions than we typically have. What it's basically saying is you normally have 0.4% price reduction, and now you're at 0.5% reduction, and that's 25% more reductions than you would expect, and the actual number is 28. Okay, now we flip over and we look at overbidding. This is how much the buyers are overbidding. Typical is 4.5%. Right now we're overbidding 4.9%. So it's 0.4% higher, which is 10% of your 4.5% overbidding. So it all depends on how you want to present the data. You can see you're very close to the gray line, and that's back here 13 weeks ago. Current data is on the right-hand side, and normally it's 6.4% overbid, and now it's 6.9. So now you're a full 0.5% more overbidding than normal. And in a competitive marketplace, 11.5% overbidding is not uncommon. And in a cool marketplace, you're only at 2.7. So you're basically right there in a normal marketplace, because your range from the bottom to the top is 9, and you're only 0.5% above where you are. So you're 1/18 of that above the typical marketplace. That's close enough to call it typical. And you can see how close to the gray line you are. Offers accepted. These are offers that were accepted that have not failed out of escrow yet. Once it falls out of escrow, it no longer counts as an offer accepted, even though it was an offer accepted, but it failed, counts as a partial. So in other words, if it's in escrow for 1 week and fails, it counts as 1/5 of an offer. If it's in for 2 weeks, it counts as 2/5, etc. So typically a quarter ago, we were seeing 1,500 transactions. That was 3/4 of where we normally are. We're now up to that 92%, and we're almost at 2,000, 1,936 transactions, offers accepted. Typical is 2,100. In a robust market, you're almost at 2,600. So you can see you're significantly down from that, and then that's 8%. Inventory. This is just your active listings out there looking for a buyer. You can see you're above the gray line, and you can see that the real break sort of happened about 2 weeks ago. Last week it came up and it went up even more this week. We now have 14% more inventory than we normally have. You have 2,050 roughly active listings. In a flooded marketplace, you only have 2,200. In a typical marketplace, you're at 1,700. Well, I'll call it 1,800. So you're more than 10%, well, you're 15% more inventory than you typically have for this time of year. Transactions, these are actually closings. What's on here, it's clearly not a leading indicator because you need closing, so you need the duration of escrow in order to have a closed transaction. But the reason I include it is that's what the industry runs on. Title companies get paid on it, lenders get paid on it, real estate agents get paid on closed transactions. But it is a significant indicator. You can see that right through here, you're right on the blue line. You came up and you really touched the gray line, and it looks like we're about ready to go back to find that blue line again, unfortunately. And the offers accepted and the closed transactions right now match fairly closely. They normally don't match this well, and that's because there's a lag time from when an offer is accepted to when it closes, normally somewhere between 3 and 6 weeks. Here's a summary. On the left-hand side is sort of the leading indicators, turnover time that we've talked about, marketing time, price reductions, frequency of price reductions, magnitude of overbidding, frequency of overbidding. And then you start getting into year-over-year comparisons of the exact same metrics. So the left-hand side, the yellow and orange, and they're orange because they're lagging, is fairly red. So that means you have a fast-paced marketplace. You got a quick turning over market and everything. But now you come to the green section, and it's basically pretty balanced. So what's that telling you? Silicon Valley is a hot marketplace normally. We're in a normal marketplace, so you're in a hot marketplace. It's completely normal over here. One thing I'm going to point out that I wasn't able to find the cause of in my short period of time is these two columns here are color-coded exactly the same, and I'm not sure where that error is coming from. And the reason I know it's an error is because 26% overbid should actually be a shade of blue, not a shade of green. We know the frequency is incorrect because 9/10 of an overbid would be sort of right there in the green marketplace. I also found out I was making one mistake that I'll explain a little bit later, and I'll make every effort to correct it by next week. It really just is a minor shift in a few color scales. But then a few other things that are of interest over here is on active inventory. I don't have the raw count. I do have the raw count, but the percentage is what's important because each micro market area has a different number of inventory and offers. And you can see Foster City that I've talked about before only has 9 active listings and 10 offers accepted. So a very small micro market area. Also, another small one is the San Mateo County coast. When I first came up with these, my goal was to have 200 transactions listings in each of my micro market areas. I'm clearly nowhere near that. I was a little bit closer when I first came up with these micro market areas in '94, but we've been on a downward trend. You would think that with growing population, we'd sell more and more homes. People get locked into their homes. Right now, 20% of our inventory apparently is heirs selling usually their parents' property, and natural cause of death and things like that, just normal life progression. That's now 20% of the marketplace in the Bay Area from a report I read recently. Appreciation is since the last 9 months of 2015. The red colors are the highest appreciation. You can see you have some areas over 100%, which would be doubling your money. I want to point out something that I think is significant. Look here at Silicon Valley. You have essentially 112% appreciation, but then when you look at each one of these micro market areas, the highest rate of the micro market areas is the Santa Teresa Blossom Valley area at 109%. So how can I have 112% appreciation for the county where the individual highest micro market is only 109? It's very simple. It's understanding statistics. If the more expensive areas, which happen to be at the bottom, Cupertino, Sunnyvale, Saratoga, Los Gatos, Los Altos, Palo Alto, if they're making up a larger percentage of the market, that raises the county median because it's the median of the homes that are selling without raising the price in the individual market areas. So you can see it's very pronounced in Santa Clara County. It's somewhat obvious in San Mateo County, but they do have one area down here, which is Redwood City, that had a slightly higher 76.9 versus 76.3. So in theory, you could do that if Redwood City was very big, but where you have, and the smallest one, the coast at 37% is a very small micro market area. And then in Alameda County, the reverse appears to be true. It's only got 75% appreciation, but each one of the micro market areas, except for Oakland, is much higher than 75%. Now, Oakland is a big area. You can see it's got 205. It makes up more than 25% of the whole county. So it could be a weighted average, which is what it would ideally be, as a weighted average. So the clearest by far example is up here in Santa Clara County. And then moving on to price, I have the median number in the middle, as well as the sandwich price, the cheapest 10 percentile on the left and the most expensive 90 percentile in the right. If you go to the lender and find out what you can qualify for, then you can come into here and find out what micro market areas are even worth looking at. Now, if you're willing to settle for a 2-bedroom on a fixer-upper, you can find something that might work for you at below the lowest price on here. But if you're looking for the cookie-cutter home and you're below the lowest range, it's going to be very difficult unless, on the other hand, you could accept maybe a busy street or a fixer-upper. So there are ways to find a home in each geographical area below the lowest price on the left-hand side, just to give you an example. Here's some definitions that you can read if you're watching on video. Here is the first PowerPoint slide of the micro market areas. And the issue that I came up with is the table lookup. When I'm looking up a number, it actually will pull the red color all the way up until it hits this first green color. what I was doing is I was using it as sort of a benchmark on the upper and lower. And in order to do that, I need to recalculate the numbers. So I'm going to have one less division in here. The colors will stay the same. The numbers will change. So it would be fairly seamless. But what was happening is here at 44, notice how you have the pink color, because this was like 45.5 or something, the first green color. So it would populate the red color until 45.5. But 44.3 should be green in color. That's the issue. Real minor, it's only on the thresholds. It's on the threshold going from red to green, and also on the threshold going from blue-green to light blue. That's why you have these numbers. 44 is one example, 42.2 is another example, not as big. 44.2 is another example. That's what triggered me that something wasn't right. The numbers are correct. The color coding is mostly correct. What's incorrect right now is the breakpoints aren't where I thought they were. It's an arbitrary assignment anyway, so it really doesn't matter, but I just want to point that out to people. Here you're looking at turnover time. You can see there's a range. The red in color is a hot seller's marketplace. The green is sort of a normal marketplace. The yellow-green up here is sort of a borderline normal hot marketplace. And the blue-green that I'm not seeing on this slide, which would be down here, is a cool buyer balanced marketplace. And then you start getting into the shades of blue, which are an ice cold buyer's marketplace. Here now is the turnover time compared to the 10-year median. So the first one was the raw count, now the median. So you can see you're pretty normal. You got a little bit of a hot spot here in Los Altos and Palo Alto. You got a cool spot in Foster City. But again, that's because that's such a small area. Here's marketing time. This is the time it takes 3 out of 4 sellers to sell. So you can see that from the color coding here, pretty much everybody's selling in under 3 weeks. 3 out of 4 sellers are selling in under 3 weeks. But let's compare to normal. It's completely normal. So for 75% of the sellers to sell in 3 weeks is a normal marketplace, which is why this is just shades of green and yellow green and blue green and a little bit of red. And I don't see any blue, but there is some blue down here in Pleasanton. So up here in Pleasanton and also Hayward. So right here is some blue. So you have all the different colors represented, but it's pretty pastel in color, which tells you it's a pretty balanced marketplace. Here's price reductions. This is the raw count. So this is fairly balanced. So that means some sellers are taking price reductions, some sellers are increasing. It's Cupertino Sunnyvale that's increasing 0.25%. You can see Union City is taking no price adjustments. A lot of people are right around that 1 percentile mark of a reduction. This is compared to normal. What would this be? Los Altos Palo Alto now is taking more price reductions than normal, 8% more price reductions. And this isn't price reductions. This is list price at the time the offer is accepted over the original list price. So that's why I said they were taking 8% price reduction. Cupertino, Saratoga Los Gatos is taking 1%. So is Santa Clara, Willowbine, Campbell, Cambrian, and Campbell. Wow, talk about red. There you go. This is the frequency of sellers' ask price reductions. So that means it's very uncommon because a lot of price reductions would be a cooler marketplace. The area where it is in double digits that I'm seeing and is the Gilroy South County area as well as the Pleasanton area. Everybody else is either in single digit, also the San Mateo County coast. I guess that's the worst at almost 30% of the sellers. So almost 3 out of 10 sellers are doing a price adjustment. Almost everybody else is in single or low double digits. So in the low teens or in the single digits for the percent of sellers doing price reductions. Compared to normal, it's fairly normal. You got some shades of blue up here in Fremont. You got some bright blue, bright red in Cupertino Sunnyvale. You got red up here in the expensive areas, but you also got blue all over the place, and you got the pastel colors. So even though the price reductions are very infrequent, it's absolutely normal for Silicon Valley. Here's the overbidding. This is the average amount of overbidding, fairly pastel in color, so you're not having a whole bunch of overbidding. In fact, the high numbers around 10%, the bulk of them are around 5%. The standout is Berkeley and the island city of Alameda. The buyers on average are coming in 19% above the seller's ask price. That's almost 20%. That's almost 1/5 above what the seller's asking. Here's the overbidding compared to normal. So even though Alameda up here, there's the island, was 1/5 higher than the seller's ask price, that's how high they normally do. So it's a supply demand issue up on the island of Alameda. I don't understand why sellers just don't raise their price if buyers are coming in a whole 1/5 higher, but long term, it's always been up there as a standout, and you can see it's close to normal. It's only 4% more than normal. 19% overbid or 18%, whatever the number was just shy of 20% is fairly normal. Now you have some blues down here, you got some greens. So again, it's fairly normal. So the overbidding is just about where you'd expect it to be for Silicon Valley. So it's not that it's a normal marketplace. It's still a hot, aggressive marketplace, but it's normal for this particular area. Here's the frequency of overbidding. So this is just the raw count. It's fairly common, but fairly common is somewhere in that 50 to 90 percentile range. You can see there's a lot right around 70%, 75%. So for 3 out of 4 sellers to be getting more than their asking price, it tells you you're an aggressive marketplace. Out Berkeley and Alameda is up there at almost 80%. Here's the magnitude of those price reductions. So this is the list price at the time the offer is accepted over the original list price. You can see that you have Los Altos and Palo Alto taking some of the largest price reductions at almost 8% price reductions. And that's the largest I'm seeing anywhere, which is a little surprising. 96%, 98, 94% in Oakland. So right now it looks like Los Altos and Palo Alto are taking the largest amount of price reductions prior to the offer coming in the door. Here's the number of offers accepted, and this is just compared to normal. So the very normal number of offers, a little bit on the low side because overall you're at 92%. You can see Santa Clara is at 95%. San Mateo County is almost at 107%. It's really Alameda County that's lagging behind at only 84% of the number of offers that they accept. And I don't have the micro market data for Alameda County on this metric yet. I need a couple more years of data. Here now is the active inventory. You can see active is basically balanced to blue. Most of Silicon Valley is a shade of blue. What are you looking at? You're looking at 40% more inventory than you normally would expect to have. So to have 40% more inventory and for people to be talking about a shortage of inventory is almost crazy. Saratoga Las Gatas, you might say is a little bit, but 4%, I would call that normal. Now at 7%, you might start saying that Los Altos, Palo Alto is a little bit missing on their inventory. Here's the appreciation. You can see some of the outlying, more affordable areas, but still reasonable commutes are to have the best appreciation, the red areas. And then sort of the peninsula had been having some of the worst, but it's recovering now that people have to go back to work more. With the pandemic and remote working, we had a blow up out here in Livermore for a while where that was having the highest appreciation because people figured they didn't have to come in to work very often. And now that people are going back, Livermore is lagging a little bit and it's returning to the peninsula. Here's the pricing. So this is simply where the prices are the highest. And again, as I've already explained, the least in the given areas on the left-hand side, the typical is in the middle, and the most expensive 90 percentile is on the far right side. So you have a price range. So just because I'm on it, Los Altos Palo Alto goes from $3.2 million on the cheapest that you'd expect to find to $5.1 million on the typical, up to 7.2% on the most expensive you'd expect. And again, here's a summary slide that we've talked about at the beginning, so I'll skip over that at this time. Here's some definitions on the upcoming chapters. So here what we're doing is we're looking at Silicon Valley as a whole. So all 3 counties, Santa Clara, San Mateo, and Alameda County, all in the blender. What is the market doing? And this is turnover time. This is that theoretical number. How long would it take to sell the market one time? Look at the turnaround. 2 weeks ago, we were here. Last week, we went up a little bit. This week, we went up significantly. So this could be an about face, because especially considering that you normally would have been going down for several more weeks. So instead of having a more and more rapid turnover time, we've turned and we're now taking longer to turn the market over one time. Here's on a percentage basis. You can see we were down here at about, what would that be? About 5% longer than normal. And now you're up here at 22% longer than normal. This is the same data as the previous slide, but on a percentage of normal basis. It's where I take the gray line, straighten it out, and then plot the purple line as a percentage of the gray line. Here's marketing time. Now it's totally flat, and it normally gets flat at right about this time with a slight downward drift. The fact that it's flat doesn't surprise me. It's a little bit higher, but you're still talking about a reasonably quick time. You're talking about 3 out of 4 sellers selling their property in 15 days. That's 2 weeks. Here's on a percentage basis. You can see you got all the way down here to under 40%. You've almost doubled because now in the last couple of weeks, I think it's only 2 weeks, we're almost up to 80% of normal. Here's the data I like, which is what are the sellers on the extreme doing? The 2.5% of the sellers that are taking the largest price reductions, how much are they taking? They're now taking a 10% price reduction. Just at the beginning part of the year, they were taking almost a 16% price reduction. So these are huge numbers because it's the sellers that are taking the biggest number. Why do I like it? Because you have movement. You're going from, well, back here, you almost had 20% to 0. So you have a 20% swing in the range of this particular metric. Most people like to look at the average. So here is the average for us. And you can see it would be getting less and less. It was coming up to the normal line. And basically this past week, it's turned around and it's starting to increase. So it's a small number. It's only 0.5% on average. And that's because the vast majority of the sellers do their homework and price their home correctly and don't have, or in 2 weeks, you don't have time to adjust your price. But price reductions are fairly rare in Silicon Valley. Here, this for comparison, remember the previous slide, the range was 20%. Here you're going from 3.2 to positive 0.2%. So give it 3.5%. Do I want to read a scale that goes from 0 to 3.5, or do I want to read a scale that goes from 0 to 20? I'd much rather read a scale from 0 to 20. Here's on a percentage basis. You're almost right up there at normal. You can see that again, on a percentage basis, the turn, and now the increasing number of price reductions, not number, but magnitude of price reductions. This is the frequency. So this is now where you start talking about price reductions are becoming more common. Now it turns in a couple more weeks typically, so it turned a little earlier, but the time shifts are a fairly rare occurrence. I pointed out one earlier in the presentation, but they're fairly rare. So this is, something you pay attention to. Is the market turning? Here's the frequency compared. So here you can see you're almost 80%. Price reductions were 20% less common than they normally are. Now you're back up to normal plus an extra 5%. So you're 105% of normal. Here's overbidding. So now we're flipping over and we're looking at what the buyers are feeling. The buyers are still clearly feeling pressure. You can see last year they were down here saying, well, we're not feeling a little bit of pressure. And then there was sort of a recovery. So then we were following sort of the normal pattern, and we're continuing to follow the normal pattern. This hasn't broken out of that normal pattern yet. But remember, because I need the sale price in order to know what the overbid was, this lags behind by the length of close of escrow. In the hot part of the marketplace, that might be averaging about 3 weeks, and that would be aggressive. In a cool marketplace, it might be averaging 6 weeks. So you change throughout the year, it's probably 4 or 5, but you hedge down a little bit in the hot time of the year, and you cool down and hedge up to the higher numbers or the longer delay in the cool time of the year. Here's the average overbids compared to normal. So this is just the amount of overbid. So here I just said this is the typical overbid. This is the 0.5% over. And I forgot what the exact numbers were. I think they were 4.4 to 4.5% for current amount of overbidding. So 4.4 would be the typical amount of overbidding down here on the gray line. That would be 0% over the typical if that's what you were getting. But since we were getting 4.9%, you're 0.5% above where you normally are. This is the frequency. The frequency of overbidding is dead normal, which is 68%. So basically just over 2/3 of the buyers are paying this, offering the seller a higher number than the seller's asking for. And there is a lot of people that are pricing homes low. My professional opinion is you should try to figure out what market value is and then go a little bit low. And the only reason I'm sort of forced to go a little bit low is the buyers are expecting to have to overbid. And if you go out at market value, buyers are going, I'm not going to go up from market value, and the house sits. Here's the frequency. You can see we were very close to 100%, and now we're coming down a little bit, so slightly less overbidding than normal, 98%. Here's my pricing model. You can see you had rapid appreciation. According to my math, it's 12.1%. And then you hit 2022, and you've basically been flat. Now notice that the 2022 peak has basically been the peak each year. So there's fluctuation absolutely within the calendar year. Some of that is changing market mix, and some of that is actually property values do fluctuate a little bit depending on the time of the year. Right now, they tend to be slightly high because, the buyers are competing against other buyers, and the buyers come out of the woodwork before the sellers do. So there's more demand than there is supply. But again, your median price is about $1,660, $1,670. For the 3 counties, you're still significantly below the $1,750 that we hit back here. And I think later on in the presentation, we'll see that no county is back up to their peak pricing yet. Here is the active inventory. You can see that you're climbing. You're now quite a bit above active inventory, and you actually have a little dip that would be interesting to see if that dip happens. I think that dip's associated with the holiday Cesar Chavez birthday that's coming up at the end of March. Here's some definitions for those that are following at home. Here's turnover time. So now what we're doing is we're basically going through the same metrics, but instead of looking at Silicon Valley as a whole, we're looking at the 3 counties. You got Santa Clara County in the blue, you got San Mateo County in the orange, and you got Alameda County in the gray. All three counties have turned around and are climbing. So it's starting to take longer to sell. Still reasonable numbers, 42 days for Alameda County, the longest, and then basically 34 days and 35 days for Santa Clara and San Mateo County. Here's time for the typical sellers to sell. Santa Clara County actually improved. Now, I'd call that a flat plateau. It's going to improve one day, which is the minimum you can improve or decline, because it's going to be whole number, because it's the 75th percentile. You take this, you line up all your sellers, you find out where 3/4 of the sellers have already sold. You look at the next property and how long did it take to get the offer accepted. Now, it is possible that that's right on the change, and the median is more typical if you have an even number of properties, and your median turns out then to be the average of those two middle numbers instead of the middle odd number. So sometimes you can end up with a 0.5%, a half a day. Here's ask price reductions. You'll notice all three counties have turned around and started to increase price reductions. This is talking about there's something that's happened in the last 2 weeks that's across the board causing the market to pause a little bit. One data point doesn't determine a trend. I always maintain it takes 3. So next week and the week after, it'll be very telling to see how long is this a trend or this is an anomaly. You can see you have some anomalies here where you have spikes up and down for 1 and 2 weeks. But once you'd have a 3-week runtime, 3 data point, that usually establishes a pattern. Here's the frequency of price reductions. Again, all 3 numbers are up across all 3 counties, and it's the consistency of the turn, the magnitude, the duration of time, the marketing time, the frequency. So far, all of them have turned. Average overbidding. Now, this is not turned, but remember, this is a lagging indicator. So this is what's happened, 4 weeks ago, maybe 5 weeks ago. So it's going to be some time before we're going to see a change in the overbidding pattern, is my prediction. Here's the frequency of overbidding. Again, no change. It's continuing to climb. Again, that's because of the lag time. Here's the appreciation. We talked about this already. Santa Clara County is up here at about 117% appreciation. The numbers over here don't subtract off the original purchase price. And then you have San Mateo County and Alameda County very close together at basically 75% appreciation. And remember, for Santa Clara County, there's been a shift of where the micro markets are most active, and the more expensive areas are making up a bigger percentage of the marketplace. That explains this huge increase in appreciation, because remember, the county number was higher than any one of the micro market areas. Here's sold price. You can see that Santa Clara and San Mateo County are together right at about 2 million. And then Alameda County is more affordable at just under 1.3 million. Same information on log paper. It looks like Alameda County actually is at 1.3, and San Mateo and Santa Clara County are under 250. I'd call that about 235, 2,035,000 for the median price for the 2 counties. They're tied again. Here's the payments. This is using the Freddie Mac National High Balance Conforming Interest Rate, which is 6% even actually. And the payment on that is for $1 million is $5,996 for the PI payment. Then I add in an estimate for taxes and insurance. And because the median sold price is just over 2 million, you're more than double that. And that's how you get the price. And it assumes an 80% loan, by the way. This is offers accepted. You can see Santa Clara County's got the most offers accepted up here at just over 850. Then you have Alameda County next at just over 700. And the smallest county, and therefore the smallest number of offers, is San Mateo County at about 375 offers accepted. Here's your active inventory. San Mateo County is about 375 active listings, so their turnover time is about 1 month, or the length of a standard escrow. Then you have up here, Alameda and Santa Clara very close together. Santa Clara has less inventory and more offers accepted, so it's got a faster turnover time than Alameda County. Here's the numbers. These are becoming less relevant. They were relevant up here where I was stressing that, the number of offers being accepted was basically at record lows. You were 9th lowest out of the last 10 years, and you were 24th lowest out of the last 25 years. And, you were basically 70, 80%, call it, of your median number. You're now at 95% of the median number of volume. So you've recovered a good chunk of the marketplace in the last several weeks. Here's the raw numbers, whether you're interested in Santa Clara County, San Mateo, Alameda County, or Silicon Valley as a whole. The different metrics are down the side. And I also will point out I have 2 different appreciations on here. I have the appreciation right here from 2020 which is basically since the pandemic. And you can see Santa Clara County's really shined, doubling the appreciation of the other two areas basically since 2020. And then you have the appreciation for the whole 2015 up here. And again, Santa Clara has really shined, not as dramatically. And wherever the recent appreciation is usually long-term because of compounding. So it's most likely the appreciation that Santa Clara County's experienced since 2020 that causes this number going back to 2015 to be higher than the other two counties. Here's some customization that I do for buyers that would like to work with me that I'm be happy to talk to you if you're in that category. I can calculate the time or distance from your commute time and distance from work to that new purchase property. And I can do that on each house. As you can see here, the time to commute is right here. These folks were more interested in time than mileage. School ratings from grade schools, whether you're a 7 or a 9 or an 8, what they are. And then I weighted average where depending on your age of your particular family, if you have children in school, you can weight the different schools different amount. The key in the things that are important to you, most people, square footage, bedrooms, bathrooms, lot size. If you're worried about what direction the house faces, I'd be happy to provide that information, as well as a link to the Google Maps here on the zip code and a link to the property details. The advantage of this, in my opinion, is you can sort through and prioritize based on your own personal needs quickly what listings you want to click on and get the details. Moving on, we have been talking about and we'll continue to talk about Silicon Valley. The last few minutes of the presentation are the Greater Bay Area, which are 13 counties and 5 regions. This is the link to the current handout. It's 73 pages. If you type the whole thing, you get there. You can also get there by typing in the green root URL, which is the green font, the letter H for handout 2026, the month of the presentation 0307. So H 2026 0307 with the green URL in front of that would get you the same 73-page handout. If you type in the green URL and the word and the year 2026 at 9 o'clock on Saturday morning, you get to the live presentation, or if you type in the blue URL link. One question I was going to ask is, would anyone like me to put up the QR code so you could snap it on your camera and link in? Would that be more appropriate since we're doing this visually? And then if you want to look at an archive or even the current session, you can go to the blue YouTube channel directly, or you can go to the green root URL and get there. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Do not do dual agencies, only single agency representation. Happy to talk about your needs, and I would appreciate likes and subscriptions. And just FYI, I was running late last week and posted on Tuesday, and I got a lot more views and a lot more new subscriptions. Unless I start getting likes and subscriptions on my as soon as available history posting, I may start delaying till Monday or Tuesday just to try to see if I can build up the channel a little bit. Please consider liking and subscribing. Here's some key distribution definitions for you, and here's the first distribution. What we're doing here is we're looking at the 50 percentile up to the 90 percentile. We're looking at the marketing time of the different properties. We're starting off on the dotted line here, the bold gray dotted line, which is basically the very bottom of this graph. The purple is the current line. We're going to step through initially for the first 5 weeks, 1 week at a time. Then we flip over and do 2 weeks at a time, and we finish up with the last 5 weeks at 1 week at a time. So let's step through and see what happens. You can see there was a slight improvement. Then it already started to go down. So you'd expect the same thing to happen this year, 1 week of improvement, then slowing down. And you can see the March, it gets slower and slower. You're in May now and you're getting quite a bit slower June. So summer is not the best time for a seller to be selling. You can till middle of July, beginning of August. That is the slowest market time in August, just before school starts. Then we saw a little improvement. See that improvement and bounce, and now it's going up, and now a huge improvement. So there was a plateau there and then a huge improvement. And that's the bottom of the marketplace, middle of October. And I'm saying middle of October because I don't have the 18th on here because it's every 2 weeks in this section. So you start drifting up until the end of the year. See the drift up. And now you're starting to climb fairly significantly. That's going to be the peak. That's the slowest we had for last year on January 3rd of 2026. And you can see the improvement. Notice how steep the slope's getting over here on the right-hand side. There's the steepest, and now it's already starting to shallow out. That means you're starting to not improve anymore, or your rate of improvement is less. And so now you're fairly shallow. So you may go down a very small amount next week, but I wouldn't be surprised if this is the best week we've had for 2026 and we already start seeing marketing times increase. Here's the same concept, but this is on largest price reductions. So now you're looking at the 97.5th percentile down here that I like. You can see it ranges from basically 16% to about 9% price reductions. It did get down to 0 back here in our record year, which was Valentine's Day of 2022, but that's very rare. And then you can see I only go down to 17.5%. So I'm looking at a 15% segment of the marketplace, because you can see here for the current week, the purple week, basically everybody from 10 percentile down. So the 90th percentile and lower is 0. So if you brought those people in, all you're doing is adding in zeros. And that's why I only go down to 17.5%. Now, maybe I should have gone down to 20 percentile to bring up some of these lines here. But, I want to try to give them the optimum optics, where here you have the most movement on the graph. Anyway, let's step through and see what happens. You can see there, then one more week was the least amount of price reductions. Then it slowly drifts down. And now it's starting to drift down a little more rapidly. Look at those drifts. And so it just marches on down. So by beginning of June, it's already noticeably larger price reductions occurring. Now July, there's the middle of July, beginning of August, slight improvement, but just really just bouncing around. There is sort of where we're now in the middle of September. Look at that improvement. And it continues to improve for a couple weeks. And now that's the peak. So for the middle of September to the middle of October, sort of a recovery, second birth of, what happens early in the calendar year where we take off. So there's a resurgence of the market right after school starts, essentially. Then we cool down for the end of the year, just stepping down slowly. They're just stepping on down, slowly down through everything. And right there is sort of going to be the bottom. So look at January 3rd, look at the improvement on the 17th, the 31st. And now you're going 1 week at a time. There's sort of the peak. And now let's continue on. See, it's already going downhill again. So we've already had the least amount of price reductions for the year, most likely. And now you're starting to already drift down with larger and larger and more frequent price reductions. Overbidding. Now, again, remember right off the bat, this is lagging behind because we need that sell price. We need escrows to close, but the concept's the same. Purple is this year, dotted line is last year, and that's where we're starting. We're starting off a year ago and going through a week at a time. So not much change for a couple weeks. I think that's 4 weeks right there, 5 weeks, 7 weeks. And that's going to be right at 7 more weeks before we really start going down. So there's the down increase, the middle of April. So by middle of April, and remember those are closing, I need closing. So that's really middle of March is when it normally starts turning down, which is only a week away from now. There's the hottest time, coolest time we had, the August 30th. And I'm flagging this one on September 20th, 7th, because those, even though you were further down here, those were fairly small increases. But let's look at the increases coming up on October the 11th. See that? And then another one up, another one, and another one. And that's sort of where we now, on November 22nd, basically Thanksgiving, we start slowing down. But Thanksgiving for closings is basically back to Halloween. See the cool down for the end of the year? There's the bottom of the marketplace. So now that's the least amount of overbidding, January 31st. But if you subtract off 5 weeks, you're basically back at the very end of December of 2025. Now you're starting to get more overbidding, more aggressive overbidding. And right coming up there is the current week. You can see that we're close to the peak for the year, and this year is less overbidding than last year. There's some definitions as we leave the Silicon Valley and start going into the Greater Bay Area. These are the 5 regions over here and the 13 counties that make up each of the 5 regions. Here's turnover time. You can see that turnover time is turned in Silicon Valley. I'll call it flat in the cities, the orange. It's still coming down, improving in North Bay. It's turned up in Central Valley and still coming down in the Central Coast. So now when you expand out to the Greater Bay Area, not all the data is turned. Remember, in Silicon Valley, all 3 counties turn, but now this is one of the benefits of expanding out and looking a little bit broader is, sometimes the market slowed down in the outlying areas and then marched back in on Silicon Valley. Typically, it originates from Silicon Valley and marches out, but it's worth keeping an eye on it. Here now is the typical time to sell. You can see flat in Silicon Valley, pretty close to flat in the cities, but the other three areas are still dramatically improving. Price reductions, flat in Central Coast, fairly flat looking in the North Bay, still climbing, reducing in the Central Valley, definitely turned last week in the cities, and definitely turned last week in Silicon Valley. So 3 have definitely turned. The coast I'd call flat. So potentially 4. The only one that hasn't turned is the Central Valley. So sellers are starting to wake up and say, hey, my house isn't selling. We need to adjust the price. Here's the frequency of the price reductions. Definitely turned in Silicon Valley, flattening out in San Francisco, definitely turned in the North Bay, definitely turned in the Central Coast. The only area where it hasn't turned is the Central Valley. It looks like the frequency, more and more sellers are doing price adjustments. Here's the buyers overbidding, clearly down in the cities. Now, the cities had the most overbidding, which is San Francisco and Marin, still climbing in the other 4 areas. But remember, this is a lagging indicator. So if the trend has just changed in the last week or two, it's going to be another 3 weeks before we see it in overbidding. Frequency of overbidding, flat in the Central Coast, flat in the cities. The other 3 regions are all climbing. So there's some inconsistencies between the different counties on which metric you're looking at, which is why I look at so many metrics. Here's your appreciation. Clearly, cities, San Francisco, Marin continues to do the least well. North Bay is second. Central Coast is next. Central Valley is coming in 4th place, which is really 2nd place. And the winner with the most appreciation is the Silicon Valley, which is all of Santa Clara, San Mateo, and Alameda County in a blender at 90%. Remember, for Santa Clara County, the appreciation was 111% or 117% and was greater than any given micromarket area. I can't stress that enough. It shows you can't use the median price to judge the value of a property. So now we have the median sold price in all 5 regions. The cities is the highest, and you can see it's below its peak. In fact, you can see all 5 regions are below their 2022 peak. You can see they've oscillated back and forth around their current level for the last 4 years now, I guess it would be, since 2022. And what's interesting too is come back here and look at where they first reached their peak price. For cities, it was halfway through 2nd quarter of 2021. For Silicon Valley, it wasn't until very end of 1st quarter of 2022. For the Central Coast, it was halfway through 2nd quarter of 2021. For North Bay, it was right at the end of 1st quarter of 2021. And for Central Valley, it was like Silicon Valley. It wasn't until the end of 1st quarter of 2022 that we hit the pricing for the first time. Here's the estimated payments. The order is going to be the same because it's just going through a mathematical formula, assuming 80% loan. You also can do better by finding out what bank, what lender has the relationship with your stock portfolio and get relationship pricing. For example, I had a client that recently got 5.5% for a 30-year fixed loan because of their retirement program. Here's offers accepted. You can see that Silicon Valley has the largest overall number of offers accepted. You can see that they're grouped basically based on their geographical and population size, because you can see that the same 3 are always on the top and the bottom 2 are always at the bottom, but the trend. So offers accepted are starting to increase. There appears to potentially be close to a rollover in the Central Valley. Silicon Valley is starting to break, but still climbing. Active inventory, all of them are still climbing. Central Coast is basically flat in the blue. The other 4 regions are still climbing. Here's the tables. This is the now column, is the current data. The 1 week ago is the change value from a week ago. So it's 1.5% higher than a week ago, and it's 9/10 of a day less than it was 5 weeks ago. So you can go through and see all the different time. It was 1 day shorter a week ago. It was 2 days shorter 5 weeks ago. The counties are on the left-hand side. The metrics are across the top. The now column is the current raw count. The 1 week ago is what you had. Was it higher or was it lower a week ago? Was it higher or lower 5 weeks ago as you go across? I don't have the change on the 10 percentile and the 90 percentile, just on the just on the median number. So you can see that a week ago it was lower. And with that, we've already gone over this slide, recapping. This has been the Silicon Valley Real Estate Marketplace, and this is a repeat of slide 60. So if you need anything, look at there. I'm not seeing any unmuted mics, so have a great day. Take care. Bye for now.